There's not a lot of action that people are attributing to this week's Fed meeting, with results scheduled to be announced Wednesday the 29th at about 2 o'clock. Um, but I think there's really more that we can be looking into here. Um, I don't expect much on the actual rate front. I think that's really off the table right now. The Fed has indicated pretty strongly that they did what they're going to do in terms of the Fed funds rate for the foreseeable future. They acknowledge that monetary policy operates with a lag as it works its way through the broader economy. And so I think that you're not going to really hear much in terms of the rate picture. But that doesn't mean you should ignore this meeting because there's a bigger elephant in the room, I think, as far as recent performance in markets is concerned, and that is the Fed's repo operations and their effect on the Federal Reserve's balance sheet. Um, I've written about this before and talked about it before on this site, but just to bring you up to speed, um, basically the Fed needed to intervene in the repo markets starting in the fall, I'm going to call it September, October period. There's various causes. The most benign cause is that J.P. Morgan and some other banks pared back the amount of reserves that they well, actually increased the level of reserves that they needed to attribute, and therefore meant that they were less able to lend that out in the repo market, which kind of clogged up the system a little bit because a whole range of banks and brokers and their customers use the repo markets to finance themselves. And seeing sort of a problem in the plumbing in that regard, the Fed stepped in, backstopped the repo market, bought a lot of short-term treasury paper via the repo market and in ways to prop it up. And bottom line, when the Fed buys treasury paper or buys assets, that means that the assets are given to the Fed and out goes money from the Fed, which pumps up the level of money in the system. So around that time, that was when you started to see the markets really take off in the fourth quarter. I find it impossible to believe that that's a coincidence. I've run some correlation numbers over the past 9 months. The level of Fed balance sheet has correlated very well with the level of the S&P. I know a lot of traders prefer to trade off of percentage correlations, but there's a lag effect, so it becomes very hard to model that as opposed to looking at the values on a 2 or 3 week lag. But so now the question remains is what is the Fed going to do? They've pretty much indicated that they're going to keep this in place sometime till about the second quarter, which gives us pretty much 2 months, 2 to 3 months of the Fed keeping the repo market operations open. But I don't know about you, but I would like a little clarity as to why they're doing this, and when it's going to end. And when it's going to end is an interesting problem. I've alluded also to the fact in various articles about why you should be looking at these statistics and how to look at these statistics. The Fed balance sheet numbers come out as part of a wide range of stuff on Thursday afternoons at 4:30. Bottom line is, over the past few weeks, the Fed balance sheet has kind of waffled without really rising or falling, a couple, up here, down there, but maybe starting to plateau. We've got to wonder now if the equity market plateaus along with that, or if the Fed starts to withdraw some of that money that's in the market, either by outright selling or just by letting some of these short-term notes roll off their books via maturity. All this is crucially important because I do think monetary policy has been driving the stock market, that and fear of missing out or FOMO, but that's a whole other topic unto itself.